Okay, let's dive right into this explainer because we really need to bust a massive myth right out of the gate. So many people kind of just assume that to be an investor, you need, a fancy corner office, a financial advisor on speed dial, or literally a suitcase full of cash. They're just sitting there, waiting for the day they get a huge promotion or win the lottery to finally start building wealth. But while they wait, their money is just sitting around in a basic savings account, essentially losing its value. The real secret to wealth isn't starting big, it's starting right now. Today, we're going to look at exactly how a small, super consistent digital habit of just 500 rupees a month can build an absolute fortress around your financial future.
Here's our quick roadmap for today. We'll cover the 500 rupee wealth myth, beating the inflation monster, SIPs versus bank RDs, the magic of compounding, navigating mutual fund taxes, and exactly how to start today.
All right, Section 1, the 500 rupee wealth myth, and why starting small is actually your biggest advantage.
Think about investing like planting a mango tree. You don't need a full-grown, fruit-bearing tree to start an orchard, right? You just need a tiny seed and the patience to water it. So let's ask let's call it the 500 rupee question. What if you just skipped a couple of coffees, or maybe one movie ticket a month? What if you took that 500 rupees and put it into a systematic investment plan, an equity SIP, consistently every single month for exactly 5 years?
Well, over those 5 years, your total out-of-pocket investment is exactly 30,000 rupees. But at a historical estimated average return of 12% in the Indian equity markets, that money doesn't just sit there gathering dust. It grows to approximately 41,000 rupees. Now, I know what you're thinking. Is 41,000 rupees going to buy you a private jet? No way. But what it does do is create a fantastic rock-solid baseline. It basically acts as a digital money jar that trains your brain to save before you spend, which is the absolute foundational habit of wealth creation.
And the real secret sauce making that 500 rupees work so hard for you, it's called rupee cost averaging. Think of the stock market kind of like a vegetable market. Prices are bouncing around every single day. When the market is booming and prices are super high, your 500 bucks automatically buys fewer units. But when the market crashes, when everyone else is totally panicking, your 500 rupees automatically buys more units on sale. Over time, this perfectly averages out your overall cost. It means you never have to stress about timing the market. You literally just set it, forget it, and let the math do the heavy lifting. Moving on to Section 2, beating the inflation monster, the hidden enemy of your savings. So, inflation is just the academic reality that the 500 rupees in your pocket today is going to buy you a whole lot less 5 years down the line. Look closely at this historical research from the RBI. The blue line here represents physical savings, like gold and real estate, while the red line is financial savings, like mutual funds. Academic research shows us that whenever inflation crosses a critical threshold of exactly 6.5%, Indians historically hit the panic button. They rush to buy physical assets to protect themselves. But the data reveals a pretty hard truth. Financial savings, specifically equity mutual funds, are the true long-term inflation beaters. Honestly, if you just keep your money under a mattress or in a basic savings account, inflation is actively eating it alive. Investing isn't a luxury anymore. It is an absolute necessity just to maintain your purchasing power.
Okay, Section 3, SIPs versus bank RDs. Let's talk about choosing the right financial tool. If we know we absolutely have to invest to beat inflation, where should that 500 rupees actually go? Let's break down the historical returns. An equity SIP has historically delivered somewhere between 10 to 14% per year. A bank RD? It's sitting at a fixed 6.5 to 7%. Now, the RD has zero market risk and 100% capital protection up to 5 lakhs, which makes it the undisputed champion for your short-term emergency fund. If you need that money in a year, for sure, use an RD. But if your horizon is 5 years, 10 years, or you're thinking about retirement, the equity SIP is vastly superior because it actually outpaces inflation. Trying to use an RD for a 10-year growth goal is literally like trying to win a Formula 1 race on a bicycle.
Let's jump to Section 4, the magic of compounding and how to scale your wealth to the next level. This is where things get really fun. This is what Albert Einstein supposedly called the eighth wonder of the world, compounding. Now, a regular SIP means you invest a fixed 500 rupees every single month, forever. It's a great start, but your ultimate secret weapon here is this step-up SIP. This means you start with 500, but every single year when you hopefully get a salary increment, you increase that monthly investment by just 10 to 12%. You won't even feel the pinch in your day-to-day lifestyle, but the mass behind this, it is completely mind-blowing. Seriously, watch how this number scales. According to our sources, if a 25-year-old starts an SIP of just 500 rupees a month and uses that step-up rule to increase it by 12% every year for 35 years, their total out-of-pocket contribution is only 25 lakhs. But because of compounding at an estimated 12% return, the final portfolio value absolutely explodes to over 1 crore rupees. With just a 500 rupee starting point, you can mathematically engineer your way to a crore. It just proves that in investing, your time in the market is vastly more important than the amount of cash you start with.
All right, Section 5, Navigating Mutual Fund Taxes. Time for the 2026 reality check. So, whenever you make a profit, the government is obviously going to want its share, right? So we need to understand the rules. The crucial takeaway here is that mutual funds are incredibly tax efficient if you play the long game. If you panic and sell your equity fund in under a year, bam, you get hit with a 20% short-term capital gains tax. But if you hold on to it for over a year, your long-term tax drops to just 12.5%. And here's the absolute best part. The government actually gives you an exemption. Your first 1.25 lakh of long-term profit every single year is completely 100% tax-free. Compare that to a bank RD, where literally every single rupee of interest is taxed at your heavy income tax slab rate, which could be up to 30%. For long-term wealth building, equity SIPs are hands down the most tax-efficient vehicle you can drive.
Finally, Section 6, How to Start Today. Let's look at your 5-minute digital setup.
The entire process is 100% digital now. You really don't need a finance degree to do this. Step 1. Just download a trusted platform like Motilal Oswal or ET Money. Step 2. Keep your PAN and Aadhaar handy for a super quick, paperless KYC verification. Step 3. Pick a simple, low-cost beginner fund. Our sources highly recommend just starting with a standard Nifty 50 index fund or a diversified FlexiCap fund. And finally, Step 4. Set up an autopay mandate for the 5th of the month, right after your salary hits. Automate your success so you literally never even have to think about it again.
I want to leave you with this really powerful thought from our sources. Your money just cannot afford to sit idle anymore. 500 rupees is literally the cost of a couple of coffees or maybe a movie ticket and some popcorn. So I have to ask you, what is genuinely holding you back from planting your wealth building seed today? Start small, stay remarkably consistent, use that step-up strategy when you can, and let the immense power of India's economic growth just work for you while you sleep. Thanks for hanging out with me for this explainer, and I'll catch you in the next one.